Do you ever wonder when the next black swan will hit? We're more familiar with the term since the financial crisis began, but the scary thing about black swans is that they're unpredictable and have a massive impact on global markets. Things like the collapse of Lehman Brothers or the September 11th terrorist attacks. Well, now, with renewed uncertainty triggered by the Japanese earthquake and revolutions across the Middle East, tail risk hedging is making a comeback. Now, these are complex, expensive products, and investors can take losses in years of calm, but can also reap huge gains when disaster strikes. And they attract the likes of pension funds and institutional investors who can afford that extra expense and want to protect themselves against ruin in the event of the next black swan. But by their very nature, we can't predict when that might be. So the interest from investors may indicate that the market isn't sure we're out of the woods yet.
So this type of extreme insurance is not for the faint-hearted. Tail risk products are highly sophisticated and they can also be very expensive. So how do investors get their money's worth? Well, joining me to discuss this is the head of risk at Bennelong Asset Management, Vaughan Robinson. Thanks very much for joining us. I suppose the first question is really, what is this product? How does it differentiate from just ordinary hedging in a volatile market?
I think well, I mean, there's a couple of things. I think in 2008, investors obviously suffered far more than they thought they were going to.
Yes.
They were relying on managers to hedge some of these risks for them, and I think they were disappointed with some of the returns, with some exceptions. I mean,
yes.
There were some people who did very well from this. So I think what they're really looking for this time is knowing how much knowing that they have a product which will hedge them in these sort of environments.
But very difficult to know that, because of course the whole point about these black swans, as I understand it, is that you don't know what they are, when they're going to come and how they're going to affect the market.
That's true, and in fact the way Nassim Taleb defines black swans is that you can't predict them. I think people talk about grey swans as being the things that you can foresee,
right?
And then therefore can do something about. I think we all have a feeling for things that we're worried about in the world, whether it's the European sovereign debt crisis or the consequences of the terrible things that happened in Japan, or even the Middle East crisis that is happening at the moment.
But awful as all those things are, they haven't been black swans as such, have they?
I don't know, I think you're right. I think the things that investors are worried about are the consequences of these events to their portfolio. So, I mean, you look at most markets now and the equity markets have managed to shrug off a lot of what happened. Most markets around the world are back to where they were at the beginning of the month. It's as if nothing had really happened.
Indeed.
And you look at the European sovereign crisis and, again, people are saying that Portugal getting a bailout is a positive thing. How do you hedge against something like that?
Indeed. And so how do you? I mean, in terms of a tail risk fund, what is it that you're able to do that hedges against these extreme scenarios?
I think there's a multitude of ways of doing it. I mean, obviously the simplest way of reducing your risk is to reduce the size of your portfolio, your exposure to the markets. And then beyond that, there's some specific things that you can do. You can short stocks, you can buy options, you can use CDS contracts, you can buy more exotic options. They all have their pros and cons, and as you alluded to earlier, some are more expensive than others.
Indeed.
I think for us, at Bennelong and our Tempest fund in particular, what we're focused on is we want to know how much we're spending for these things. We want to know how much we're risking. So short selling stocks doesn't work for us because you've got potentially unlimited upside or downside.
Indeed.
So we're structuring a fund which has options and option style payoffs. So where you have a fixed downside and you have asymmetric upside. And it's that type of portfolio that we want to put together. And
who buys these typically? Who buys into these kind of funds?
Well, I think your article before was talking about pension funds are the ones, and really that's probably when we were setting up the fund, that's who we thought would be most likely to have it. And I think high net worth individuals are probably the people who it also suits as well. Those people who have, let's say, a salary which is linked to the financial markets. They have a stock portfolio, they have beach houses and all the rest of the stuff. And they're concerned that they're only facing one way.
Yes, indeed. Yeah.
So you've got high net worth individuals at one extreme and pension funds at the other, and obviously it's easier for the high net worths to allocate to something like this than it is necessarily for a pension.
Because it is expensive, right? I mean, it's a bit like insuring against your house and your car and all of these things and hoping that it'll never happen. But it's a lot more expensive than that, right?
I think the expense. I mean, we strongly believe that if you mitigate the cost of the protection, you mitigate the payout. So if you can try and reduce the cost, but the more you reduce it, the less likely it is to help you when you want it to. I think, and I think the other thing is to say is that it's not quite as expensive as some people might think. I mean, if you were to look at S&P puts, then I agree that that is quite an expensive way of hedging your portfolio, and a lot of investors that we speak to have lose patience with using S&P puts time in, time out. But if you look at actually where we think the risks are, which is in the sovereign space and currency markets, those things that are set apart from the corporate balance sheets, which have effectively been repaired as a consequence of the actions that politicians took, it's not as expensive as you think, and you can actually get some quite good asymmetry.
Okay, interesting. Now, what about the current interest in tail risk? Apparently you're seeing more of an interest. Is that because of all the events that are happening worldwide?
I think it's funny that you say there's more interest. I mean, if there were a dozen European long-short funds that were launched over the last 6 months, I don't think we'd be having this conversation.
Right.
So there's no doubt that there is more tail risk funds than there were a year ago, but maybe that's where the market needs to be. In terms of whether or not there's enough of them, or whether they're doing what they're supposed to do, or I mean, I think it boils down to a couple of things. If you're an investor, you have to establish what it is that you want to protect against.
Yes.
And you have to establish how much you're prepared
Losing
to spend
money,
on it.
presumably.
Well, yeah. But I mean, there's an interesting thing that most of the investors that we speak to are actually have been quite bearish, and you could say that they're self-selecting. They've chosen to talk to a manager who's selling a tail risk fund.
Indeed.
But they're bearish, and yet when you look at the way that their portfolio is structured, it's all facing one way as well. I mean, I guess the tail risk, if you're a bearish guy and you've allocated to short funds, the tail risk is that markets continue to go up. Maybe you need to buy call options, or you need the other tail protected.
Indeed. Okay, well, it's a fascinating subject. Thank you very much indeed for joining us to explain more about it.
Thank you.